Welcome to the Biz Easy podcast, where small business is simplified for greater results. Brought to you by Resources and Development. Go to www.resources-development.com for help in taking your business to the next level. And now, help me welcome the host of the Biz Easy podcast, Steve McCrillis.
Welcome to the Biz Easy podcast, your resource to help take your business to the next level. My name is Steve, your host, as we all learn how to stay better focused on the things that make you great. I'd like to introduce you to my partner and our resident guru coaching, our lead business coach, Skip Williams.
Hey, thanks, Steve. How you doing today?
Excellent.
All right, but it'll get better, right?
Yeah, always.
Hey, today I thought because we're talking about financials, I'd give you a couple of numbers jokes. So did you know that I have a phobia of negative numbers? Yeah, well, I stop at nothing to avoid them. All right, bad rim shot there. To the person who invented the number 0, all I want to say is thanks for nothing.
We got 2 rim shots all in a row. Okay, we're rocking and rolling.
We're ready to move forward. Okay, so maybe this will be more helpful. If you treasure it, you should measure it. This old adage is more commonly known amongst bookkeepers and financial consultants, and not to throw accountants and CPAs under the bus, but their primary concern is to be able to prepare a tax return at the year's end for you to know how much taxes you may owe. It's kind of a backward thinking proposition, but it shouldn't. You know, you want to know if you're making money while you're making it.
Agreed.
Let's use your car as a metaphor. How do you know if you're low on gas, if your car is running too hot, if your oil pressure is at a dangerous level that might shortly damage the engine? You simply look at your dashboard, right? There's a series of lights and gauges that help you decide when something is okay or worse if something isn't. It provides you with information to make a decision to get gas soon, add coolant to your radiator, or add oil, but it gives you that information right away. In your business, your dashboard is your accounting system if it's set up properly. If you use QuickBooks or any small business accounting system, there are several reports you can download to look at. The 2 major reports that every business owner should pay attention to. The balance sheet is the first one. It gives us a snapshot of our business at any point of time. We look here to typically see our bank balances, our accounts receivable, who owes us money, or our accounts payable, who we owe money to. And I won't spend a lot of time here on the balance sheet, but a balance sheet can also tell you how much equity the business has by subtracting liabilities from assets.
Now, it's kind of like your house, yes? When you're talking about equity, it's how much you paid for the house, how much you owe on the house. So the difference is the equity, right? So let me ask you, make it biz easy for us, Skip.
Okay.
How important is it to know how much equity you have in your business?
It's not typically important on a day-to-day basis. It's more valuable when you're thinking about selling your business. You want to bring somebody into, the partner into the business. Whenever you need to know the value of your business, knowing the equity becomes more important. But on a day-to-day decision-making idea, knowing how to analyze the P&L, or sometimes called the profit and loss statement or the income statement, is going to be far more important on a day-to-day basis. The P&L tells us what has happened over the course of a period of time. It tells us what revenues we earned, how much we spent to get those revenues, and how much we spent on our overhead. While typical periods of time to look at is usually a quarter or a month or a year, you can run these for any custom time period you need. Now, this wasn't always true, Steve. In the old days, we posted and closed our books each month. But with QuickBooks and other accounting programs, if we keep our inflows and outflows up to date each day, we can provide accurate reports for a week period, a 10-day period, or whatever period you desire.
In my experience in working with business owners on the road, one of the first things I would have them prepare before I appeared was a balance sheet and an income statement or P&L. I asked them for 3 to 4 years. I was shocked at the number of business owners who didn't know how to prepare that. Moreover, when I got there and showed them how to do it, or their bookkeeper or their accountant, I would turn those financials around and give them to them and say, tell me what it says, tell me what you see. So let me ask you, what information do you find most small business owners like to have at their fingertips?
Yeah. So the first part of what you said, it's what we've talked about in other podcasts too. It's, we tend to revert to our core competencies and we stay away from the things that we don't enjoy or aren't very, or perhaps aren't even very good at. So Steve, the first part of the P&L shows us our revenue or sales for the proverbial top line. There can be more than one type of revenue, as you'll often see sales revenue, interest revenue, other types of revenue. There may be additional types of revenue, in fact. If your business has different types of sales revenue, I would recommend making sure you have a line for each. For example, if you're a printer, but you also sell advertising, I would recommend having a revenue line for each of those. Because as we're about to talk about, they have very different costs associated with each type of revenue. The second part of the P&L shows us our expenses. And if we set up our accounting properly, it'll show us our COGS. And this has traditionally been called the cost of goods sold, or more recently known as the cost of goods and services, which is also known as your variable expenses. And then, of course, lastly, there's also the fixed expenses, also known as overhead. The reason it is important to have these two expenses segregated is so we know how much it costs to serve our customer with the goods or the services, like labor, materials, etc., and how much it costs just to have our doors open for business, i.e., rent, management, labor, etc.
In your experience, how many of your clients really didn't segregate? Well, I can tell you about mine, but how many of your clients didn't segregate between variable expenses, those go up with the amount that you sell, and those that are fixed, specifically that are overhead?
I'd say probably half and half. And I think even the half that have it probably lucked into it by having a good accountant set up their books or something like that originally.
Well, I find that I find that most small business owners don't really know how much it costs them to keep their doors open. Their overhead costs, if you will, their fixed costs. How dangerous is that?
Well, if you want to learn anything from your P&L, you need that. As far as danger, you can still do your taxes with that, which I was about to say, that if your P&L does not reflect COGS and fixed expenses separately, you may want to work with your bookkeeper to fix the issue. Without that segregation in your books, like I said, it's still good for tax purposes, but it's not very useful for managing your business. The last part of the P&L is the profit/loss line, or the bottom line, which tells us during this period how much money was left from the top line revenue after we paid for the variable and the fixed expenses. If it's a negative number, we did not bring enough revenue in, or we paid too much for expenses. Therefore, it's a loss.
Okay, Skip, why don't you walk us through how to read the P&L in basics? Make it biz easy.
I'll make it as easy as I can for you, Steve. When I look at the P&L, the first thing I look at is fixed expenses to see if any one of them are significantly different than previous periods. If they are, then I immediately look into finding out why. I also look at each line of fixed expenses periodically to see if we're paying for want-to-haves or need-to-haves, or to see if there's alternative sources that may be cheaper. The next thing I look at is the variable expenses, or the COGS, as we were just talking about. To look at these properly, we can't compare them to other months on a dollar-to-dollar basis. We first have to convert that dollar amount into a percentage of revenue.
Before we go on, let me circle back. Explain what you mean by if we are paying for want-to-haves versus need-to-haves. What do you mean by that?
Well, in any business, or for that matter, in any personal household, we want to make sure that we're spending most of our money on need-to-haves and not want-to-haves, or nice-to-haves is another way to put it. So, we need materials that go into the product or the service that we're selling. But do we need the new fancy latest gadget to facilitate that, or is that just a nice to have?
Gotcha. Your last statement, you had said that you wanted your advice is to convert that dollar amount to a percentage of income. So if you have a P&L without percentages, well, why create them and how do you create them? Two-part question.
All right. Well, normally, in order to, because revenue fluctuates, our cost of goods or services is going to go up or down as well. So the fact that this month's labor number or materials number doesn't match last month's may not be a big deal if it's the same percentage roughly of the revenue. Does that make sense?
Yeah.
So normally we divide each expense by total revenue, but if you have several types of revenue that are significant or material, then rather than dividing the expense by the total revenue, you should divide it by the corresponding sales revenue that created those COGS expenses. This will provide the most accurate picture of what it costs to create those sales. Once you have an accurate percentage of each of the cost of goods expenses, then you can compare those percentages to the previous months to see if something is JDLR, like I like to say, JDLR, or just doesn't look right. But an even simpler way to track this is with the contribution margin method. Here we take a total of our COGS and divide it by the corresponding sales revenue to obtain how much it cost us to make $1. Then we reverse that by subtracting that amount from the dollar to find out how much we keep out of every dollar before considering overhead. So this is just your variable expenses divided by the corresponding sales revenue, and then subtract it from $1. Go ahead.
Gotcha. I have a question. I'm going to save it to the end, but the question that I have right now is, or first, give us an example of that so that we can understand what you're saying.
Well, I'll use some really simple numbers here, Steve. So let's say your total revenue for this period that we're looking at is $100,000, and our total COGS is $65,000. Therefore, we know that it costs us 65 cents to make $1, right? But
Okay.
and then we reverse that, subtract the 65 from the dollar to put it in the form of a contribution margin, which says we keep 35 cents out of every dollar, every sales revenue dollar, to pay for our overhead and contribute to our profit. Does that simplify?
Yes, that makes sense. Okay.
Now, the reason I like the contribution margin method is that I can track each month and compare to see if our operations are getting more efficient or less efficient. I can do the calculation mid-month. I usually try to match a pay period, so I get the labor costs of a pay period, and I can match it against my and materials costs for the same period, and I can match it against the revenue for the same period. I can also use the contribution margin to divide into my overhead to obtain what my break even is. And if everybody doesn't know what break even is, that's simply the amount of money for that period that revenue it's going to take for that period in order for us to break even. We've covered all our expenses, but we haven't made $1 yet. I can determine how many revenue dollars or additional sales it will take for me to pay for a rent increase, a new hire, a company car, a new computer, anything like that. I can even use this number and share it with department heads or even line personnel to provide a measure of efficiency without giving them all the details of the bookkeeping. This one number goes up or down each period, and we can see if we're more efficient. I can also use the contribution margin in my ROI calculations when I'm investing in a new piece of equipment, or I can use it in calculating pricing for goods and services. So for people who hate numbers, as well as people like myself that enjoy the numbers, this can be a useful one-number tool for managing your business, Steve.
For the many businesses that I've been to, one of the first things that I did from an analytical evaluation is convert all of their numbers to percentages so you can compare them period over period, year over year, however you wanted to do that. But when they receive help from an accountant or a bookkeeper to set up their chart of accounts, it's always alphabetical more than it is by fixed and variable expenses. Mm-hmm. You also made reference to identifying those costs that go against a specific revenue. Is it possible, which is typical, that Peachtree, which is now Sage, or QuickBooks to be able to do that on their platform the way it's set up now?
There's so many different versions of everything, and I'm not that familiar with Peachtree. I've used it a couple times, and it depends on what level of QuickBooks that you own. But sometimes you can print them out with the percentages right there. That's correct.
Okay.
Not all. I don't believe all versions do it, but many do.
A very common question that business owners ask me is, well, if I have, and I'll use your example of printing, we have printing costs, we have advertising costs. Do I need a separate set of P&Ls and balance sheet for each of those revenue streams, or can I do it composite in one?
Yeah. So if you have more than one revenue stream, like I said, dividing something into the total revenue doesn't, or by the total revenue doesn't give you an accurate picture. So it'd be best if you could create a cost of goods section for each one of those. Not all bookkeeping systems are going to allow you to do that. So therefore, maybe you put a prefix or a suffix on the name of that expense, so that you know that it goes to one type of sales revenue rather than the other. Be my best recommendations. But you've done this, you've had to do this many times on the road. I've done it a million times too. Like you said, all the expenses are there, they're alphabetical. So you basically, you just have to go through them. I use a highlighter and color the different ones different colors. So if it's overhead, I'm coloring those one color. And if it's a cost of goods, I'm coloring it another. And if you have two different types of cost of goods that you want to calculate, use a third color. And then you just add them all up, and you've got three numbers. You've got an overhead number and two cost of good numbers, and then you can go to town from there.
What I would like to underscore from your comments is, at very least, get a method of measuring. You said it in your very first sentence. If you treasure it, you should measure it. Measuring your sales, measuring every cost that comes through your building, identifying how they relate to variable expenses versus fixed overhead expenses. It becomes very critical, even if you write it down. In fact, I work with people that are still using that green lined paper. You remember that, with all the grids and all that. As long as you have a means by which you measure your business, measure your costs, measure your sales, then and only then can you take it to the level that you spoke of, which I think is critically important, to be able to see. Information is only as good as the decision that you can make from it. And if you quantify that, it's not that complicated. When you break it down the way you did, you can see the changes, and then you can adjust. I think that you've been an advocate throughout the entire podcast arena that you make a change, you adjust, make a change, you adjust, simply.
Yeah, analyze and adjust, analyze and adjust. That's right. Yeah. You alluded to the old green bar paper days, and you can imagine how difficult it was to get this information then. But even in today's world, even if you're getting the most simple, basic P&L out of your accounting system, you can export it into Excel, and you can go crazy from there. And I do this for a lot of clients. What I do is I'll create a dashboard, as we alluded to in the first part of the podcast here, with all the things that we want to measure, all the things that we treasure and we want to measure. And then I will create a simple paste in tab where you just take and paste in the information that you get out of QuickBooks, and the spreadsheet does all the work. It finds the information it needs, so that you can have your metrics right in front of you for any period you want. And I love the fact that in today's day and age, that once we post that payroll each period, that makes a perfect 10-day, 14-day, whatever period of time that we can measure, so that we don't have to wait until, let's say, February 17th before we can start analyzing what happened in January. And what's that? 15% of the month of the year has already gone by before you're actually able to do any analysis at all. So I love the fact that we can start analyzing, let's say January 20th for the first half of January, and we can see what if anything's out of whack, and we can make the adjustments sooner rather than later.
This is a very important topic, and I think that anybody who's interested call in, write in, email in. We'll be happy to walk you through some of these concepts again. But in the interest of time, Skip, let me ask you, any last thoughts before we go?
Sure. After all that money that you spent to keep the books up to date, wouldn't it be nice to have them to be a very useful tool that helps you manage your business rather than just an expense to make an accurate tax return? Information is only as good as the decision that you can make from it. With this brief overview of key performance indicators from your P&L and balance sheet, you can make more informed decisions about the operation of your business. After all, it's not how much you make, it's how much you keep. Steve says that over and over. Take it from someone who hates accounting. You don't need to be an accountant to make good use of your accounting. It costs the same amount of money to keep your books up to date as it does to do it all at the end of the year for the tax man. And it might even be less. So why not get a better return on the accounting expense by making sure that it's a useful tool for your day-to-day decision making? And in reference to our opening, happy motoring, and please reach out for more detailed information.
Excellent. Appreciate it. And
that's a wrap.